Welcome to the Deep Dive Library, your go-to podcast for real talks on entrepreneurship, finance, and personal growth. No fluff, just bold insights to help you grow, build, and lead. Let's dive in. Today, we're tackling some really fundamental questions about investing, questions we hear all the time, like, what's the safest way to start investing as a beginner? How do I invest if I don't actually have a lot of money? What's the real difference between active and passive investing? How do I avoid losing money in the stock market? That's a big one. And should I be trying to pick individual stocks, or is it better to invest in things like index funds? So we've really dug into a range of materials for you. We looked at some cornerstone books like Ramit Sephi's I Will Teach You to Be Rich, which is super practical.
Like a classic for getting started.
And John Bogle's The Little Book of Common Sense Investing, plus some other great articles, all focusing on, practical, beginner-friendly ways to get your money working.
Yeah, and the common thread really seems to be about just starting, keeping things simple, and thinking long-term.
Exactly. So our mission today is to unpack all that and give you some clear, actionable insights, because it feels like so many people just get stuck right at the beginning, overwhelmed maybe.
Absolutely. That initial hurdle, that feeling of, oh my God, where do I even start? It's probably the biggest barrier. It's like like looking up at a huge mountain and thinking you need to be an expert climber right away.
Yeah, that's it. People feel like they need an MBA or a huge pile of cash just to dip their toe in. So what do these sources tell us about just getting going? The
core message, and it's really powerful, is that getting started is so much more important than being perfect. Ramit Sethi, he talks about this idea of the 85% solution.
The 85% solution, what's that?
It basically means that taking action, even if you only feel like you figured out 85% of it, and getting it mostly right, is way, way better than doing nothing while you try to figure out every single tiny detail.
Okay, that makes sense.
Because doing nothing guarantees, well, nothing. Zero progress. But doing something, even if it's not perfectly optimized, you start learning, you start benefiting from compounding, you can fix things as you go. It's actually okay, maybe even good, to make small mistakes early with small amounts. You learn lessons for later when the stakes are higher.
Progress over perfection. I like that. Don't let the hunt for the absolute best thing stop you from doing anything. Okay, but practically speaking, if someone feels like they barely have any spare cash, how do they start? Where's that first step?
Right. That's where automation comes in. Building an automatic system for your money is pretty revolutionary for most people. It's a foundation a lot of these experts recommend.
Automation, like automatic transfers?
Exactly. Setting up an infrastructure so your money just flows where you want it to go. Paying bills, saving, and yes, investing, without you having to consciously decide every payday. It just happens.
Takes the willpower out of it.
Totally. And you can start really small. I Will Teach You to Be Rich specifically mentions even $150 a month can be a starting point. The key isn't the amount initially, it's the consistency. And automation drives that consistency.
Right.
And this applies to bills too. Automate what you can. Use a credit card for recurring bills maybe, paid off automatically in full. You might even get rewards. Or use your bank's bill pay feature for things like rent. Set it and forget it.
It's like you're engineering your money's path, that whole pay yourself first idea, but automated so you don't even see the money in your checking account to be tempted by it. I heard someone call the checking account your email inbox for money.
Oh, I like that.
It comes in, but you need filters to automatically send it where it needs to go, bills, savings, investments, before you think about spending.
That's a great analogy. And for anyone worried about needing a big lump sum to open an account, that's pretty much old news. Most major brokers now have $0 account minimums, $0 to open.
Seriously, zero.
Yep, and $0 trading fees for buying stocks and ETFs.
Okay, hang on, ETFs. Can you just quickly break down what an ETF is for someone new to this?
Oh, sure, good point. ETF just stands for Exchange Traded Fund. Imagine a basket that holds a whole collection of different things, usually stocks, sometimes bonds, whatever. When you buy one share of an ETF, you're basically buying a tiny slice of that entire basket.
So instant diversification, kind of.
Exactly. And you can buy and sell them easily throughout the trading day, just like a single stock. They're super popular for beginners because they're simple and give you broad exposure.
Got it. So $0 minimums, $0 trading fees for stocks and these ETFs, that really lowers the barrier to entry. How do you actually get money in there?
Usually pretty straightforward. Set up an automatic transfer from your checking account. Or if you happen to have, say, an old 401k or another investment account somewhere else, you could usually transfer those assets over electronically.
Okay, so the mechanics are easier than people think. But what about safety? How do I know my money's actually safe with this online broker?
Very important question. And there are definitely safeguards. In the U.S., most legitimate brokers are regulated by groups like the SEC and FINRA.
SEC and FINRA.
Right, sorry. SEC is the Securities and Exchange Commission. FINRA is the Financial Industry Regulatory Authority. They're basically the watchdogs. They set rules, oversee the brokers, all to help protect investors.
Okay.
And on top of that, most brokers have something called SIPC insurance. That's the Securities Investor Protection Corporation.
SIPC.
Yeah, and this is key. SIPC protects your assets, your stocks, your bonds, cash held at the brokerage up to $500,000 with a limit of $250,000 for cash. But here's the crucial part. It protects you if the brokerage firm itself fails, like if they go bankrupt.
Okay, so if the company running the account goes under, my investments are protected up to that limit.
Oh,
But it doesn't protect me if my investments just go down in value, right? If the market drops.
Precisely. And that's a really critical distinction. SIPC about broker failure, not market risk. Market risk, the chance your investments lose value because the market goes down. That's just part of investing. It's inherent. And managing that risk comes down to your strategy, not insurance.
Got it. That clarifies things a lot. Protection against the firm failing, not against the market going down. Okay, so before we dive into strategies for managing that market risk, what about people who feel like they can't invest because they're just buried in debt, especially like high interest credit card debt?
Oh, yeah. High interest debt it's like trying to run uphill carrying weights, particularly credit cards with those crazy APRs.
APR being?
Annual percentage rate, the interest they charge you per year. And yeah, credit cards can easily be 14%, 18%, even over 20%. It's brutal.
So what did the sources say? Debt first, then invest.
Generally, yes, for high interest debt. The advice is pretty consistent. Prioritize aggressively paying that down before you start making significant investments. Think about it. The return you get by not paying 18% interest is a guaranteed 18%.
That's a return you can't really beat reliably in the market.
Exactly. It's guaranteed. There was one calculation mentioned showing if you had $5,000 in credit card debt at 14% and only paid the minimums, it could take over 8 years to pay off and cost you almost $2,000 just in interest.
Wow.
But if you doubled the minimum payment, you'd be done in just over 5 years and cut the interest paid by more than half. Getting rid of that debt frees up so much cash flow, not to mention mental energy.
That really paints a picture. So tackle that guaranteed drain first. What strategies do they suggest for actually getting rid of it?
Well, finding extra money by making some temporary sacrifices is one. Setting up automatic debt payments, just like automatic investing, so it happens consistently. And sometimes even trying to negotiate with the credit card companies. Maybe they'll lower the rate or waive a fee, especially if you're struggling.
Yeah.
It helps if you track calls you've made before.
So persistence can pay off there too.
It might. Now, balance transfers, they get mentioned. Moving debt to a 0% introductory offer card. It can seem tempting.
Yeah, seems like a quick fix.
But many experts kind of see it as a band-aid. It might give you breathing room, but it doesn't address the underlying spending habits that maybe led to the debt. You got to fix the behavior too.
Right, treat the cause, not just the symptom. Okay, so let's say you've got debt under control, cash flow's looking better, you've opened an account, automated some savings. Now you face the actual investment choices. Active versus passive comes up a lot. And picking stocks versus funds, let's unpack that.
Right, so active investing, that's the hands-on stuff. Either you or a professional fund manager are actively trying to pick winners, specific stocks or bonds you think will outperform, or trying to time the market, jumping in and out. The goal is always to beat the overall market average.
Okay.
Passive investing is different. It's about buying investments, usually these index funds or ETFs we talked about, that simply aim to track a specific market index, like the S&P 500, which tracks 500 large U.S. companies, or maybe a total stock market index. You're not trying to beat the market. You're just trying to get the market's return.
So active sounds, well, frankly, more exciting, right? Like trying to find the next big thing. Passive sounds maybe a bit boring. Just buy a fund and hold it.
That's definitely the perception. One author contrasts this idea of sexy investing, the thrill of the chase, with the more, quote, boring buy and hold approach of passive investing.
Yeah.
But as John Bogle, the founder of Vanguard and a huge advocate for index funds, used to say, investing isn't supposed to be entertainment. It's supposed to build wealth. And when you look at the actual long-term evidence, the boring passive approach wins overwhelmingly.
Why is that? Why is it so hard, even for the pros, with all their resources, to consistently beat the market average over time?
There are a few really solid reasons that come up again and again in the sources. First, maybe the biggest one, costs. Bogle called it the relentless rules of humble arithmetic.
Humble arithmetic.
Yeah, costs matter hugely. Active investing means more trading, right? Buying, selling. That generates transaction costs. Plus, you're paying higher fees, management fees, for the manager's supposed skill. If it's a hedge fund, you might pay performance fees too. All these costs eat directly into whatever returns you make, year after year.
With a constant headwind.
Exactly. Low-cost index funds, on the other hand, they just follow a recipe, the index.
Yeah.
There's no genius manager to pay high fees to, so their costs are incredibly low, often fractions of a percent.
So paying less actually gets you more in the end.
In investing, bizarrely, yes, often. Paying almost nothing in fees for an index fund means you keep almost all of the market's return. Paying high fees means that manager has to first beat the market by enough to cover their fees, just for you to break even with the index fund. It's a huge disadvantage from the start.
That makes sense. The fee hurdle.
Yeah, and there was a podcast discussion pointing out how even small fee differences compound massively over decades. It also mentioned newer investment products often have lower, more transparent fees than older ones, and some firms give fee breaks if you have more assets or link family accounts. But the bottom line is always your net return. What do you actually keep? Lower costs give you a massive edge.
Okay, fees are a killer. What else makes active so tough?
It is just incredibly difficult, maybe statistically near impossible, to consistently pick the winning stocks before everyone else realizes they're winners, or to perfectly time market peaks and troughs.
You hear stories, though.
You do, but the broad data is stark. Study after study cited shows the vast majority of professional fund managers, we're talking maybe over 90% in some studies, or even calculations suggesting odds as low as 1 in 223,000 over the very long run, as one book mentioned, fail to beat their benchmark index consistently after fees.
1 in 223,000. Wow.
Yeah, it's staggering. There's that famous anecdote about wine experts being fooled by red wine dyed white. It just highlights that perceived expertise doesn't always translate into measurable, consistent skill, especially against simple, systematic approaches. In investing, results are what matter, and most active managers just don't deliver market-beating results reliably over time.
So if the pros, with all their time and resources, struggle so much, how can a beginner realistically expect to succeed at picking stocks or timing the market?
That's the crux of the argument for passive index funds.
Yeah.
They're transparent.
Yeah.
What you own, it's just the stocks in the index. They're incredibly tax efficient.
Yeah.
Because they don't do a lot of trading, so you don't get hit with lots of capital gains taxes each year like you might in an active fund.
Right.
Now, people who promote active investing might say passive is too limited or the returns are just average, which is true. You won't massively beat the market, or that it just follows the market down when it falls. But the historical performance, the low costs, the simplicity, it all points towards passive index investing being a much more reliable strategy for the average person building long-term wealth. You earn your returns by owning a piece of the whole economy's long-term growth.
Okay, that's a strong case. So low-cost passive index funds look like a solid core strategy. But beyond that choice, how else can you reduce the risk of actually losing money? That's a huge fear.
Diversification. It's absolutely fundamental. And this means more than just owning lots of different stocks. It means spreading your money across different types of investments, what we call asset classes.
Asset classes, like stocks, but also...
Stocks, yes, but also things like bonds, maybe real estate. You can get exposure through REITs, for instance.
REITs, remind me.
Oh, right. Real Estate Investment Trust. It's basically a company that owns or finances income-producing real estate. You buy shares like a stock, and it lets you invest in real estate without actually buying buildings.
Okay, got it. So stocks, bonds, REITs, other things.
Could be commodities, international stocks, and then within each class, you diversify further. Within stocks, you own companies of different sizes, large ones, small ones, different industries, different countries.
Why is spreading it out so important?
Because different types of investments don't always move in the same direction at the same time. When stocks are down, bonds might be up or stable. When the US market is struggling, international markets might be doing well. Diversification smooths out the ride. It reduces the overall volatility of your portfolio because you don't have all your eggs in one basket. If one part tanks, hopefully other parts cushion the blow.
Makes sense. Avoid putting everything on one bet. So index funds help diversify within stocks, but a really diversified plan might include index funds for bonds or international too.
Exactly. The specific mix your asset allocation really depends on your personal situation. Your age is a big factor. How long until you need the money? Your goals, and importantly, your tolerance for risk. How much volatility can you stomach without panicking?
Right.
Younger folks, maybe in their 20s or 30s, have decades before retirement. They can generally afford to take more risk, hold a higher percentage in stocks because they have time to recover from any downturns. Someone closer to retirement might want more stability from bonds. But diversification across asset classes is crucial at any age to manage risk.
Okay, diversification helps smooth the ride. But what about that other big fear? Investing a chunk of money right before a huge market crash. How do you avoid that terrible timing?
Yeah, that's a tough one mentally. But it goes back to what we said about market timing. You just can't reliably predict short-term market moves. Nobody can. Trying to jump in and out based on feelings or forecasts usually leads to buying high when everyone's excited and selling low when everyone's scared.
The classic mistake. Totally. So the sources emphasize focusing on time in the market, not timing the market. And the best way to do that consistently is through regular automatic investments. It's a strategy called dollar cost averaging, DCA.
Dollar cost averaging, how does that work?
It's simple, really. You commit to investing a fixed amount of money at regular intervals, say $200 every single month, no matter what the market is doing. High, low, sideways, doesn't matter. You set it up automatically.
And how does that help with timing?
Well, when the market price is high, your fixed $200 buys fewer shares. But when the market price drops, that same $200 buys more shares. Over time, it averages out your purchase price. You end up buying more shares when prices are low and fewer when prices are high, automatically. It takes the emotion and guesswork out of trying to find the perfect time to buy.
So discipline and consistency again, just keep investing steadily through thick and thin. Exactly. Patience and consistency are your superpowers here. And sticking to your plan is most important when things get volatile. Market downturns are scary. That's when your risk tolerance gets truly tested and the urge to hit the sell button is strong.
Yeah, I can imagine.
That's why having a clear investment plan, knowing your risk tolerance before the storm hits, is so vital. It helps you resist panic selling, which just locks in losses. And honestly, this is where a good financial advisor can sometimes really earn their keep, not by picking magic stocks, but by being that objective voice, that behavioral coach, helping you stay the course when your emotions are screaming at you to bail out.
Having someone talk you off the ledge, basically.
Pretty much. Objectivity is hard when it's your own money on the line.
And fees, coming back to those, they also impact avoiding losses, right? In the sense that they just guarantee you keep less.
Absolutely. Relentlessly. High fees are a guaranteed loss compared to a lower cost alternative. Market downturns might be temporary if you hold on, but fees are a permanent drag year in, year out. Sticking with low-cost index funds helps protect your returns from being nibbled away.
Okay. And we also heard about tax-advantaged accounts being important. How do they fit into boosting returns or minimizing losses?
Oh, this is huge for long-term growth. Using accounts like a 401k, especially if your employer offers a match, and Roth IRAs is a critical strategy. The tax benefits are incredibly powerful over time.
How so? What's the difference?
With a traditional 401k, the money you contribute often goes in pre-tax. That lowers your taxable income now. Your investments then grow tax-deferred, meaning you don't pay taxes on the gains each year. You only pay taxes when you withdraw the money in retirement.
And the match?
The employer match is basically free money. If your company matches, say, 50 cents for every dollar you contribute up to 6% of your salary, you absolutely want to contribute at least that 6% to get the full match. Not doing so is leaving money on the table.
Definitely don't want to do that. Okay, what about the Roth IRA?
Roth is kind of the mirror image. You contribute money you've already paid income tax on. So no upfront tax hike, but, and this is the biggie, your investments grow completely tax-free, and when you take qualified withdrawals in retirement, those are also completely tax-free.
So you pay taxes now, but potentially save a lot more later, especially if you expect to be in a higher tax bracket in retirement.
Exactly. That tax-free growth on decades of earnings can be enormous. The sources often call using these accounts 401ks, Roth IRAs, the 85% solution for taxes in investing. For most people, maximizing these accounts handles the bulk of tax optimization needed.
Plus, holding investments long-term gets better tax rates too, right?
Yes, if you hold an investment for over a year outside of a retirement account and then sell it for a profit, it's typically taxed at lower long-term capital gains rates compared to short-term gains on things held less than a year. But ideally, especially within those 401ks and IRAs, you're aiming for buy and hold. So selling and triggering taxes isn't happening often anyway.
Okay, this is all starting to connect. We've got get started, automate, use low-cost passive index funds, diversify across different assets, use dollar cost averaging, keep fees low, and leverage those tax-advantaged accounts. How does someone pull this all together into, like, a plan?
It really has to start with goals. Having a plan, even a simple one, and knowing why you're investing. There was a great story in one source about two friends saving. One was just vaguely saving money. The other was saving specifically for a down payment on a house.
And the one with the goal did better.
Way better. Much more motivated, much more successful. Your goals, whether it's retirement, buying a house, financial freedom, traveling the world, whatever, they provide the why. They give you the motivation to make the trade-offs needed to save and invest consistently.
So don't just invest to get rich in the abstract. Connect it to what you actually want your life to look like.
Exactly. Money should be a tool that serves your life and your goals. That's where a conscious spending plan comes in, even a simple one. Know your take-home pay. Decide how much goes to fixed costs, how much to investments, how much to other savings goals, and then this is important, how much is left for guilt-free spending.
Guilt-free spending. I like the sound of that.
Yeah. Knowing you've covered your bases allows you to spend the rest without worrying. And the final step is automating those investment and savings transfers based on your plan. That makes it happen consistently, month after month.
So have a plan tied to your goals. Automate the key parts. Stick with low-cost, diversified investments like index funds, use the tax advantages, and just let it run for the long term.
That's pretty much the recipe. It allows you to build wealth almost by default. You become a successful investor not by being smarter than everyone else or finding secret stocks, but by setting up a simple, effective system and having the discipline to let it work over time. You make the important decisions up front, how much to invest, what funds to use, automating it, and then you can focus on living your life, knowing your financial future is being taken care of.
We've covered a lot of ground today, from overcoming that initial fear of investing to understanding why simple, low-cost, passive index funds often win out, the power of making it automatic, diversifying your bets, and really focusing on that long-term picture using tax-advantaged accounts.
Yeah, the core message from all these different angles seems remarkably consistent. Keep it simple, keep costs low, be patient, automate, and stay diversified. That's generally the most reliable path for most people.
It really makes you think, doesn't it? If the evidence is so strong that trying to constantly beat the market is incredibly difficult, maybe even counterproductive for most people, does chasing the exciting trade or the next hot tip just distract us from the simpler, probably more effective strategy that history seems to favor? Something to consider. Okay, that's our deep dive for today. And hey, if you found value here but haven't subscribed yet, why wait? Every subscriber fuels this channel to keep delivering the real game-changing content you need. Hit like, drop a comment, and subscribe. And now, don't miss out on the next episode that could change everything for you.